Corporate finance practice problem using OneNote. Poison pill calculation. Get ready, it's time to take your chance with corporate finance. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon left-hand side, the practice problems tab, then down in the 1712 poison pill tab. Also note, when using OneNote, look at the immersive reader tool. Our presentations will be mirrored down in the text area, same name, same number, but with transcripts. Transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, information up top, calculations then on down below. We're looking at a poison pill type of situation. There could be different kind of setups for a poison pill type of situation, but the idea would be to deter somebody from doing what would be like a hostile type takeover, from purchasing a substantial or significant share in the stocks and therefore having a controlling interest in the organization. So the idea then would be to set something up so that it would take effect automatically if it was, triggered by some event that happened, such as an individual, buying a significant amount of the stocks, and then it would be set up to dilute or cause pain for people that are trying to basically clear that position and buy like a controlling interest of the stock. It'll make it a problem. It'll cause some pain, cause them a little bit of poison there, which will hopefully deter that from happening. That's the idea. So we have the shares outstanding, the 14 million, the sales price 75. And the poison pill takes effect if a hostile group purchases a percent of shares that are 17%. So we're saying if, a concentrated group or person purchases the 17%, then we have set up that the poison pill then will take effect at that point. What will happen then? Well, the existing shareholders will be able to buy new shares at percent below the current existing stock price. So whatever the stock price is, then they get an automatic decrease or this discount. Now, of course, the idea of the decrease or the discount isn't really so the company can simply generate capital with the issuance or sale of common stock at that point in time. What they're trying to do is incentivize the current stockholders to purchase more stock at the discounted price, which they probably will if the price is substantially below the market price, and that will then dilute the position of the people that are trying to consolidate control possibly, and in that way it'll make it more difficult for someone to reach the goal of possibly getting to a level of shares that they believe will give them a significant control in the organization. So that's the idea of it. So if we have down here, for example, the shares that would need to be purchased by a hostile group for the poison pill to take effect, then if we said that the poison pill is going to take effect at the 17%, the hostile group, the group that we're assuming wants to come in and acquire a substantial amount to have significant influence over the stock, which is something that the current stockholders, the current position holders may not want, and that's why they put in the poison pill position. When would that take effect? Well, if the shares outstanding are the 14 million and then we had 17%, you would have to have 2,380,000 shares that would be consolidated or purchased by the hostile group in order for the poison pill to take effect. At that point, then, there would be concern. The concern would be, or the reason this position would be put into place is because there would be concern that they're going to get a significant controlling interest. Therefore, this drop in the market price goes down by the 25%, so that you can then go to the current shareholders and say, hey, look, we want you to purchase at this price. We have a discounted price here, substantially discounted, so that we can dilute the population of shares that are out there and make it more difficult for the consolidated group here to get the controlling interest that they would like, causing them pain, making it difficult, hence the poison pill name that we have. So the new price for the existing shareholders in our calculation, the current price would be 75, then 1 minus the percent below the current price, or 25. In other words, if you get a 25% discount, just like anything with regards to a discount, that means that you have a 75% price. So we got 75% price times 75 in terms of the current price, and that gives us the 56.25. So we're going to say, okay, this individual, this group or whatever, went above the amount consolidated above the point where the poison pill takes effect, and that means that we're concerned about the possibility of someone consolidating enough a controlling type of interest, and the poison pill takes effect, meaning there's a decrease for the current shareholders of the price. That's a market price currently 75, going down 25%, basically discounted. So now it's worth 56.25. We can then offer that to the current shareholders, and hopefully they'll take that, given the fact that it's substantially below the market price. And if so, then we can basically dilute the shares and once again make it more difficult for this group to basically acquire a controlling interest in that way.